But in the early stages, it's all about team. So founder vesting is super important. And if I see founders arguing against that too much, it makes me nervous. It's like, why? Where are you going? And sometimes I think founders sometimes read more sinister intentions into founder vesting than I think's warranted. It's not about seeing the founders come away with nothing. It's just making sure that we've got you, because that's what we want.
Hi everyone, welcome to episode 151 of the Startup Playbook podcast. I'm your host Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, strategies to you succeed, and their advice to current and future entrepreneurs. I'm delighted to have Kylie Frazer, the co-founder and partner at Flying Fox Ventures, as my guest for this episode. Kylie started her career as a lawyer before jumping out of the legal industry to initially launch an innovation lab for professional services before going on to launch a health tech startup called Scancheck. After exiting out of Scancheck, Kylie then transitioned over to the other side of the table as an angel investor through her angel syndicate, Eleanor Ventures. She has now teamed up with one of my other favorite people in the ecosystem, Rachael Neumann, to become the co-founder and partner at Flying Fox Ventures. Unlike traditional VC funds, Flying Fox Ventures has a unique cohort-based model with a rolling $5 million fund to invest in 10 companies. Once that capital is being deployed, new and existing investors have an opportunity to invest into the next $5 million fund. In this interview, we covered a wide range of topics, including the difference between the angel investor and VC mindset, the terms on term sheets that you should pay attention to and what not to spend time on, the importance of founder runway, the benefits that come from the Flying Fox Ventures unique rolling fund model, and much more. Without further ado, here is my interview with Kylie Frazer. Hi, Kylie. Welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
Thanks for having me, bro. I'm excited.
Likewise, your very first podcast interview. So very excited to help tell your story on the show. But Kylie, I know we've known each other for a little while, but for the benefit of those people that don't know you as well or don't know your story, do you want to share a little bit about your background and what got you here today?
Yeah, sure. So I'm a co-founder and partner at Flying Fox Ventures, which is a brand new early stage venture firm that helps angel investors to start their investment journeys. It's grown from Eleanor Ventures, which I founded a couple of years ago. And yeah, it's just kind of grown super organically, which has been really exciting. Before that, I was a corporate lawyer, and in between those two things, had a stint as a founder.
Yeah, and I wanted to kind of double click on that as well. You know, obviously I wanted to kind of cover the vast experience that you've had as an angel investor and obviously what you've done through Eleanor as well and some of your legal background. But what founders may not know is that you were a former founder before and you had a couple of different businesses. Do you want to sort of share what they were?
Yeah, sure. So the first business that I founded, I was on maternity leave and I thought that professional service firms were ready for an innovation lab to help them explore big picture themes like, flexible working and philanthropy and, connection. Turns out they were not. This was I think it was in 2010, maybe 2009. Innovation labs weren't really a thing in Australia, let alone in professional service firms. So that failed quickly and spectacularly, and also in that really embarrassing and confronting way when you design a business that is too close to your own backyard. I had spent my whole life in the law, and kind of failing in front of people that I respected was that wasn't the easiest thing that I've ever done. But as I said, at least it happened quickly. And I think the thing that I learned most from that little episode was how difficult it is to really sell product when you come from a services background. I had plenty of people that wanted to buy me as a service to help deliver the kind of innovation themes that I was promising, but no one really wanted to buy the product. And I am very sensitive towards selling my time. I think that's something else that is entrenched when you've been a lawyer for so long. There's lots I loved about the law, but selling my time was not one of them. And my first business was inadvertently just another way to sell more of myself in 6-minute units. So yeah, was glad it failed quickly rather than going on to really wipe me out with the death of 1,000 cuts of selling time.
Yeah. And after that, from what I understand, you had another company as well called Scancheck?
Scancheck was more successful and not in the law. So whatever its destiny was going to be, it was not going to be so personal to me, because I had no background whatsoever in medtech, but I had went back to business school to do an MBA, dropped out after I met my co-founder there, and she was very interested in radiology. Her background was in radiology and kind of health systems, and we put together a business that did second opinions of radiology scans, which was more successful than the Innovation Lab, you'll be pleased to know. But ultimately, we kind of grew apart in where we wanted to take the business. I was super excited about creating this like beautifully clean, structured data set, which radiology just lends itself to, right? Particularly second opinions, because you just have all the inputs you need to create beautiful data sets. But it was also like a very early and well set up telemedicine tool, and it ended up going down a more kind of telemedicine path rather than a data creation path, which is cool. But I exited that business and started investing off the back of that, which was cool.
Yeah, and I'm really curious to know from your own experience as well, because I think it's always fascinating to see how people sort of experiences shape, especially on the investing side, in terms of how you view particular opportunities. What you just mentioned in terms of Scancheck in particular, wanting it to not be something that was as close to what your previous business was. Obviously there's a lot of talk that goes in terms of having deep domain expertise around the particular business, and that being really important in the teams. Has that kind of shaped how you sort of view angel investment deals in particular, in terms of, I guess, the founder background in the specific industry that they're looking to start the business in?
Yeah, I mean, it's funny. I always look for deep connection to the problem, even though my own experience was sometimes it's just too close. But I think it's usually easier to solve problems that you have firsthand experience of. But it's not, it's not a fail safe, right? Because sometimes you just think, you make the mistake of thinking that you are the customer. And I am not representative of the people in law firms who buy services. I never was one of those people. I just, happened to work in a law firm and thought I had all the answers. So you actually have to be careful that you don't fall into that kind of hubris of assuming that you are, that you are the solutions that you're thinking of are the solutions that everyone wants. And sometimes that's a bit easier when you're a bit more removed from what the business actually is. But would looking back, would I have invested in me as a founder of Scancheck? I mean, probably not. If I'm honest, I didn't have a lot of legitimacy to bring, in terms of my own background at that stage. Like I'd never. I'd never grown a startup successfully before. I didn't have deep domain expertise. My co-founders and I were on slightly different trajectories as well. Like you could kind of see the writing on the wall with the benefit of hindsight. But yeah, lucky I didn't have to make that decision. Although I did. Funny story. When I was thinking that we would raise around for Scancheck, I actually went and joined a bunch of different angel groups. That's the first time that I had ever really thought about investing. And I thought, oh, well, because I still had my rich person certificate from my lawyer days, I thought I could just pose as an investor and go in and learn about how to invest as an investor rather than as a founder, which is, it's a pretty cool hack. And if there's anyone out there with their rich person certificate that wants to infiltrate the groups, I highly recommend it, because it gave me a really good education and a real insight into how early stage investors' minds work, which has been invaluable and really instrumental in how I've thought about building Eleanor and then flying Fox up.
Can you share in terms of what some of those learnings were? Like, I think that's often there is often this sort of real lack of understanding from a founder perspective because they're so deep into their kind of own business and their own specific industry and vertical that often it's hard for them to kind of look at it from kind of the other side of the table, or really kind of understand what is it that angel investors are looking for, or what are the different types of opportunities that kind of come across their table. Can you share what some of those learnings were from infiltrating that angel group at that time?
Yeah, I mean, it's funny. The lessons that I learned then are very different. Well, I don't think they ever stopped learning. Like we've got 275 people who've invested with Eleanor, and I've learned something from nearly every single one of those interactions. So, but those first lessons from the angel groups, the most important one was probably the need for speed and the need to be able to access the best deals. You needed to be able to move quickly, and you needed to be able to activate a significant amount of capital. And sometimes some of those angel groups were not great at either. And I'm a bit of a process junkie. Like I just love smooth, fast processes. And it just struck me as a missed opportunity that you had these great people in a room together, but they were kind of let down by some of the process stuff, which wasn't a lack of process. Some of these processes were almost over-engineered and not really tailored for what was best practice in early stage startup investing.
Yeah, that's really interesting insight. And so in terms of I guess in terms of getting to be on the other side of the table and actually investing in deals, what were some of the learnings that you had in terms of how investors at that time were sort of assessing different opportunities, or kind of learning that maybe you didn't know before joining the angel group?
I mean, I didn't. When I first started, like I was coming in from a standing start. There was lots for me to learn, and I had some very good teachers just in terms of how to pull apart a deal. And I guess the way that they teach you in those groups is very similar to how traditional venture firms look at deals. Things like traction, TAM, team, technology, all the T things. And that's kind of angel fundamentals 101. But what I have learned since then over a much larger number of interactions is that there's this other aspect to angel investing that is very different from how venture firms operate. And some of the groups aren't great at accommodating that. And that's the kind of personal element, right? Like you can speak to 10 different angels and they will come at something from 10 different angles. Angels and angles, that would be a terrible thing to have to write. I would make mistakes everywhere. But that makes it super hard for founders because, like what turns me on isn't going to turn someone else on. And that's really difficult for an angel to for a founder to be expected to do their diligence at that very granular level on individuals. But it's kind of what my job now is, with wrangling more angels than anyone, I think. And there have been some themes that I guess I've kind of distilled under that big heading of everyone is different, and these are themes, not rules. But I think angels need some help sometimes in explaining their investment rationale. How did they get to this decision, and how can they justify it to others? And part of that, some people do that in terms of, well, how am I going to make sure that I don't look stupid? Is there someone else clever who's coming in with me? That kind of, looking to other people for signaling. That kind of protection is really important to some angels, in a way that it's not as important to venture firms. The other way some angels think about that investment rationale piece is it's almost like, well, how do I explain this? What happens if this investment fails? Am I contributing something else to society? Like, is it leaving behind a corpus of knowledge that another team can pick up and take? Am I investing in individuals who are going to go on and do something else extraordinary? Angels tend to really think about that piece deeply. It's not to be confused with philanthropy, because my view is that philanthropy doesn't belong anywhere in early stage investing. We are here for financial returns, and that's okay to be very upfront about that. And impact investing is kind of its own area again. But there is this kind of space in between those things for just regular everyday angels who do think about, well, what if this fails? What am I going to leave behind? And can I live with that? Because no one likes to lose their own money. It's all well and good for firms to talk about, investments that returning the fund and going from 0 to 100 and not a lot of time for what's in between. But, when it's your own money, you're normally pretty happy just to have it back. Mm-hmm. And it's like one of the main differences between being an angel and being a funder, I reckon. But there, I promised you two things that angels look for. The first is the investment rationale, however that comes out. The second is the way they enjoy talking about it to other people. Like, being an angel investor is fun. Like, it's one of the coolest things you can possibly be. Obviously, I'm completely biased, but it's a great, people that do it tend to love it and tend to want to talk about it all the time. So founders need to make sure that they give in potential angel investors the kind of tools and the language to talk about their company easily. Because if I don't understand it, I'm going to feel really silly talking about it to my friends. And this actually comes back to the point we were talking about at the start of the conversation around investing too close to home. Or starting a company where you have almost too much subject matter expertise. We've invested in a great company called AdaTree, which does consumer data right integrations. So it provides like technology solutions to get people started with open banking in the first instance. Now, we've got a lot of financial service investors who don't necessarily know a lot about CDR, don't really understand the technology that's required to empower CDR. It's almost harder for those people to invest in AdaTree than some of our investors who come from, the arts, who don't have any idea, but it sounds cool and the founder's great. So they can kind of, we can take them along on a thesis, but they're not expected to be experts. So if you are, sometimes a little bit of knowledge can actually be a detriment when you're targeting those investors.
Yeah, that's really, really interesting insight. Yeah, I was actually on a call recently with Jill as well, and what they're doing at AdaTree is absolutely fascinating as well. So big shout out to Jill and AdaTree there. One of the people that I was able to speak to in doing research for this interview was Ben Williamson from Fresh Equities, who I think was one of the first syndicate deals for you as well.
He was Fresh Equities was the first when we were kind of a public syndicate. So we did a bunch of stuff when we were a private syndicate, but once we got the AFSL and started syndicating for everyone, Ben and Fresh were the first.
Yeah, and they're doing an absolutely incredible job as well. But one of the things that he kind of really sort of highlighted from a founder perspective in terms of the benefits of working with an angel like yourself or kind of going through a syndicate is just the honesty that kind of comes from a lot of the feedback. And I guess from a founder perspective, just knowing that because the money is coming from the investor themselves, the type of feedback that they're getting or those sorts of things can be trusted in a slightly different way, potentially to being the advice that's given from let's say a larger sort of traditional VC fund, which might have different types of models or different outcomes that they're looking for, which I thought was a really sort of interesting insight from a founder perspective. But, again, for any founders that are potentially going through a fundraise for the first time or looking to kind of raise their next round of capital, do you have any advice in terms of how founders should think about composing that round in terms of what are the different types of groups that they should go for? Or is it better to just to keep it really simple and just go and ideally fill it with one traditional VC fund? Should you have a combination of that plus angels? What's your advice? I know this is broad strokes, but what would you normally suggest to a founder?
Look, I think it's good to have a small mix. You don't want to have, you don't want to have a cast of thousands in there because the dynamics can be interesting. We've invested with probably nearly all of the leading VC firms in Australia, with Blackbird, Rampersand, Investable, Folklore. I think there's not many that we haven't invested with Airtree. But the role that we can play that is helpful for founders is what we call like investor wrangling. Like it's our job to not to get all the investors in line, but sometimes what a big venture firm needs is not necessarily what the founder needs at that point in time. And because we are a little bit independent, we can help those sides, kind of come together to really understand what the other needs, and there's usually a compromise to be had. So I think there's always a place for strong angels. One of the things we've been really good at is helping founders bring in their desired strategics as part of our syndicate, so it keeps the cap table nice and clean. And you've got those really important, evangelists working for you whilst they're also investing. So that's been popular. But I think everyone gets really hung up about constructing the ideal round, and the reality is that not many of us have that luxury. Sometimes you just focus on getting the money in and figuring it out later, and that's fine too. Like most investors these days are all kind of Hippocratic Oath investors. They won't do any harm, as long as if that's the best that you can hope for, then it can be worse.
Yeah. Absolutely. One other thing that Ben mentioned to me was the monthly portfolio calls that you do with everyone that you've invested in, which I think is a really interesting way for founders in your portfolio to kind of share everything that they're going through and kind of share and learn from each other and hopefully help each other out in that process as well. One of the other things that has come up multiple times on this podcast when speaking to investors is the really strong need for building that sort of founder-investor relationship, and for founders to be able to go to their investor with specific problems or be able to lean on them.
Yeah.
Again, do you have any sort of advice or insight into, what a founder should expect or want from an angel or from a particular investor in terms of cadence of communication, in terms of what they should be looking to reach out for, and signs that potential founders should look for when they're speaking to investors to identify whether they'd be the right fit for each other as well?
Yeah, I think there's investors who are good coaches, who have a good broad mix of skills, who are excellent at kind of coaching founders throughout the whole process. And Rachael Neumann, my investment partner, is one of those just extraordinary coaches. And then you have people who have more vertical experience, like say expertise in particular areas. So whether it's setting fundraising strategy or designing customer success platforms, or like whatever, finding product market fit, like whatever that vertical is, there are people who will be great at that. So you want to think about expertise in as being able to tap into what you need and when. Your investor doesn't always have to be your coach. If your investor isn't a great coach, that doesn't necessarily have to preclude them. There's plenty of other ways where you can get that ongoing assistance as and when you need. I think that for the thing that we have learned at Eleanor is that you can kind of have as much structure around that investor portfolio engagement as you want, but so much of the work is crisis driven. Like we have, Rachael tends to have regularly scheduled coaching sessions with the founders that she works with, whereas my role is just to leap in when things don't go right. And it's early stage investing, right? Things don't go right all the time, so you can have the best laid engagement plans, and then you just roll up your sleeves when you need to. I think one of the things that we had planned, like the original kind of Eleanor 1.0 model, was that we would invest at seed and just get people through to the Series A, at which stage your big investor would come in and they would pick up all of that deep portfolio work, and we'd go back and focus on the next round of companies. But that didn't work. And I think there's something awesome about that relationship between the first believers and the founders, and no one wants to break that up. Like Ben at Fresh Equities doesn't really need me in the way that he used to, but that doesn't mean as soon as he pings me, like I'm there, because like I love the guy. I'm going to bend over backwards to do whatever he needs, and it's always going to be like that.
Yeah, and sometimes it's kind of hard to predict what that might look like as well. So Ben actually shared something. I think he mentioned it was at the end of year sort of update to investors. And he mentioned that you were one of the first, or kind of the people that was definitely sort of pushing for them to think about potentially raising a round when they didn't necessarily need to, and all of the benefits that were involved in that. And which I think is kind of, again, really interesting from a founder perspective, because again, you can be so knee deep in kind of just executing that sometimes it can be really important to have the people that are sort of around you to help think strategically, or kind of give different levels of input as well. One of the other things that he kind of mentioned in terms of working with you as well is just the honesty that you sort of come with, and essentially being kind of the backer or the believer, but also being able to call them out on particular things. And so I think what he mentioned was, with this particular round, they were looking to raise a traditional kind of sizable round, and I think you went back to them and said, actually, is this really how much you need, or is this really the sort of right amount, and what does this mean? And have you considered kind of doing your own thing instead of doing what's sort of expected of you as well? Again, can you sort of unpack that a little bit in terms of what that sort of looks like from an investor perspective in trying to provide that type of advice to founders?
Yeah, I mean, and it's every situation is different, but I think some founders and some investors get really hung up about perfectly structured rounds that like you raise $1 million at seed, and then you raise 5 million at A, and it's just like, well, who says why does it have to be that way? I'm as a general rule, I like founders to only raise as much as they need to kind of unlock the next set of meaningful milestones. That doesn't mean only raise the bare amount, because what is a meaningful milestone is one of the hardest things to actually really figure out in any kind of fundraising strategy. But Fresh was one of those is one of those extraordinary startups that can pretty much turn on profitability whenever it wants. So it was always going to have flexibility. So I just wanted them to protect their cap table, to make sure that they were going to be the ones benefiting from their extraordinary growth, like where we are in it to partner with founders and make sure that we create outcomes that the risk of being really blunt makes people rich. Like I want to make founders rich. I want to help my investors get rich. Like I think it's just really simple goals.
And hopefully a great outcome for everyone involved as well.
Fingers crossed.
Fingers crossed. So Kylie, obviously, one of the things that you've also mentioned to me before is just kind of the learning process that gets involved, when people do start investing, particularly angel investing for the first time. And Rachael did also mention that there's a bit of a story behind your kind of first deal. And I think you mentioned that you were a little bit sort of trigger happy as well. Do you want to share, I think it's also beneficial for founders as well to sort of understand that from an angel investment point of view as well, in terms of what that sort of looks like, and what has that kind of learning experience meant for you in terms of how you look at deals now compared to what it was like when you first got started investing?
I feel like this podcast is just becoming an exploration into all the mistakes I've made to get me here, which is completely fine, because one of the things I love to say is that it's always better to learn from the mistakes of others than your own, where you can. And my first angel check, my first arm's length angel check, had all the hallmarks of terrible investment decisions. So it was in a sector that I knew nothing about, robotics, so hardware, deep tech, deep IP, very green team. And I didn't really know what was a reasonable check to write, and I was kind of flush with cash and wanted to prove that I'm here to deploy capital. So I wrote a check that was about 5 times what I currently write, just because I thought that's what I needed to be at the table. The company didn't go great. I won't say what it is because it is technically still a going concern. But what I learned from there was that you need to give angels the confidence to be able to invest smaller check sizes. It's okay to do that. I can see from the founder's perspective, you can't take 10K checks from everyone. It ruins your cap table. You can't do that. But there is a place for syndicates and other structures that bring angels into that environment where they can learn, where they can deploy smaller amounts of capital in a way that they're still getting access to the best deals while they figure out what's really important to them.
And again, like on that, do you have any advice for founders in terms of how many of those potential sort of 10K deals or kind of smaller checks they should look for in a particular round?
So the magic number is 50 shareholders before you go public. So you have to get for an Australian company, you've got 50 spots on your cap table to get to IPO. So you need to think about how you spend them. Your later stage investors will help you clean up your cap table. So if you have to bring on 20 angels to get started, that's okay, because if you're growing, there will be scope to try and go back and clean that up. And by cleaning it up, I don't mean that you kick them off. It's just, you might kind of incentivize them to transfer their investments into a syndicate or into a trust structure so that you have more streamlined holdings. But I think when I first started mentoring at StartMate and being more involved in the startup sector, I think there wasn't a lot of knowledge or discussion around clean cap tables, and I saw most cap tables that I saw were pretty ugly. Now I think the pendulum's swung back the other way, and everyone's so focused on having clean cap tables that people are coming to me and ask if I can help, wrap up a structure to clean up their cap table. It's got 10 investors on it. It's like, relax, like it's not going to break you. You just have to get all the way with 50, and you can fix it at any point.
Yeah. So Kylie, one of the other things that Rachael mentioned to me as well, in terms of getting to work with you over the last few years, has just been your sort of superpower in not just being a great lawyer, but also having a really commercial focus as well, particularly in understanding, what are specific terms in term sheets or those sorts of things that you'd really need to focus on, and what are things that you can sort of overlook, or as you mentioned, things like cleaning up cap tables can be things that can be done at any point and doesn't necessarily need to be a focus area now. For a company that's at the early stage, potentially raising their sort of pre-seed or seed round, what are kind of terms or things that they should be really mindful of and make sure that are included, that are in their best interest? And what are things that, people spend potentially a little bit too much time on that maybe isn't as important in the long term?
Yeah, interesting. So from an investor perspective, I'm always looking at founder restrictions on sale. So whether that's founder vesting or reverse vesting, that's really important to me because I'm investing in the team, not in the company. As the company matures, then founder vesting becomes a little less important because someone else can walk in and keep the beast moving along. But in the early stages, it's all about team. So founder vesting is super important. And if I see founders arguing against that too much, it makes me nervous. It's like, why? Where are you going? And sometimes I think founders sometimes read more sinister intentions into founder vesting than I think's warranted. It's not about seeing the founders come away with nothing. It's just making sure that we've got you because that's what we want. So that's probably, it's one of the areas where I probably have the most discussions. In terms of what we don't put as much stock in, restraints. So and again, this is coming from my legal background. Like, do you know how hard it is to actually have a restraint enforced? You can put whatever you want in there, but courts hate enforcing restraints unless there has been valuable consideration paid for a restraint. If I've just invested in your seed round 5 years ago, there's no way that a court is going to think that that in itself constitutes reasonable consideration, is my view. So I think sometimes there's just too much talking about. I would always trade a restraint for founder vesting. There can be a place for both. And I think it helps set the expectations around, well, what do we do when this ends? So I think that is a worthwhile conversation to have, because investors get upset if a company fails and then the founders go and do something identical in a new vehicle 2 months later. And a restraint is a useful framer for that conversation. But, in terms of legal enforceability, I don't think I'd be rushing off to court anytime soon.
Absolutely. And, just kind of touching on kind of co-founder relationships as well. I think it was really interesting, your experience with Scancheck in particular, when you mentioned that, I guess, potentially the interests of the co-founders was a little bit different. And I think, one of the things that really sort of strikes me, and having known you and Rachael for a really long time, is, what a amazing sort of relationship and dynamic that the two of you have as well. When I spoke to Rachael in terms of this interview as well, she mentioned that I think you met at an industry dinner, and she said it was sort of professional love at first sight. But, I know that you guys have been working together for a little while, for over a year, before deciding to start Flying Fox as well. But, I think that sort of dynamic in that relationship and the way that you approach that is very similar to, I guess, how a startup should be looking to build up their sort of own founding team as well, or bringing co-founders on. Do you want to share what that sort of journey has been like from when you and Rachael sort of first met to starting Flying Fox together?
Yeah, so working with Rachael is an extraordinary privilege. She has a great set of skills, but even someone with a great set of skills doesn't mean that you're going to have a great working relationship. And we see founders breaking up all the time, and we didn't want to be those people. So we've been investing together behind the scenes for the last year. Eleanor Ventures has been the investment group powering her working theory angels. So we really had one back end, but two front ends. And that way, if we didn't fall in love, if we didn't really like working together, if we found we challenged each other in all the wrong ways rather than all the right ways, then we would each have somewhere to retreat to without it being a big, co-founder breakup story. I think particularly as women leading venture firms, we just didn't want to see a headline saying, women founders in bitch fight or something awful like that, which, would probably make for good copy, but you're not going to see it here, because Rachael and I, we're pretty into each other, and I think we're going to be together for a long time.
Yeah, I think Rachael described, to keep that analogy going, Rachael described Flying Fox to be the love child, the professional love child between the two of you. But, I think one of the other sort of interesting things, aside from both of you being sort of amazing sort of operators and individuals in your own right, and having just a great dynamic between you, is the unique model that both of you have taken with Flying Fox. Instead of raising a traditional venture fund, as is the case, I think that you have a really interesting and kind of different model in the market. Do you mind kind of sharing, for the benefit of the listeners, what that model is, and I guess from your perspective, what some of the benefits of that are?
Yeah, of course. So we've been inspired by angel list rolling funds, which allow investors to join a fund at various stages rather than just having a straight open and close. The rolling funds in the US are kind of designed to respond to some peculiarities in US securities regulations that aren't appropriate here. So it's not a direct cut and copy. It's inspiration only. But what our cohort model does is we get angel investors to come along and invest in 10 startups with us. That means that they're able to build a diversified portfolio, and if it also gives us check size certainty. So we always know when we're going out to talk to founders what our minimum check size will be for any investments. The cohort investors can choose to top up and invest more in any deal if there's additional allocation. But the idea is that we're really giving investors the tools that they need to grow in their angel journeys. It's hard to get started, and having that safe place to discuss, to blame me and Rachael if something fails, because some of them will, like the stats are not in our favor, around half will fail, and that never feels good. But doing it in a safe environment where you've got other people around you who are looking at the same thing and making the same decisions with you, I think is pretty empowering.
And from a Flying Fox perspective as well, what's the perfect fit for you in terms of potential investment opportunities, and when should founders be reaching out to you?
It's never too early. So we're kind of firmly seed, but we will do some pre-seed stuff, and we've done a couple of Series A at the lower end of the scale. We love founders. The way we think about it is kind of a mix of empathy and execution. So we want the founders to bring, not only empathy for their customers, but for their team members. We want, this is a human-centered business, and we want to make sure that we're investing in founders who understand and love humans. And then the execution piece is, can they actually deliver? Can they get stuff done? And are they workers? There's that great analogy of porpoising. We love founders who can, come up and look at the big picture, do the strategic stuff, and then dive down again into the weeds and grind out what they need to before coming up again and taking stock of what happens. They're the kind of founders that we love to invest in. Sector agnostic, we skew pretty heavily towards software and SaaS, but we've done some deep tech stuff and will continue to do so.
Speaking of, I guess, falling in love with founders as well, because I guess this is just a running analogy that we'll keep for this this interview. But going back to the start of the interview, when you mentioned that, if you were to look at Scancheck, potentially wouldn't have been the right fit for various reasons. But, one of them being that it wasn't, you didn't necessarily come with a whole heap of credibility and background in health tech in particular. I'm thinking for a lot of first-time founders, particularly younger founders as well, who may not have that sort of industry experience or track record, or, for just an early stage company that may not have a huge number of data points there for the business on its own. What are markers? What are kind of particular things that they can do or demonstrate that will help you fall in love with them without having more of the traditional data points around you?
Yeah, the answer to that is customer obsession. Like, even if you don't understand it, if you can show me that you are obsessed about your customers and about listening to your customers, how many prospective customers have you spoken to? Like, how are you listening to them? How are you dissecting those learnings? How are you testing the learnings that you're pulling out from there? Complete obsession with your customer will cover a multitude of lacking in other areas.
I hope you don't mind me mentioning this as well. One of the really interesting things for me of being part of the first cohort with Working Theory Angels was obviously getting to learn a lot from both you and Rachael. And one of the things that I found really interesting through that process was, I think a question that you asked of founders is just really sort of understanding their own personal runway. And I guess the importance of that, especially from an investment perspective. Do you mind sharing, I guess, why that's important for you from an investment perspective?
Yeah, it is. And it's something you have to be careful about, right? Because you don't want to only invest in founders who have got no other life distraction around them. Like, life happens, and we don't own. If you only invested in founders who had safety nets, you'd invest in rich white founders every time, which is not of particular interest to us. So the way that we think about personal runway is, just how much is still left in the tank for these founders, and what supports do they have around them? And support can come in many ways. It doesn't have to be a trust fund, that they can tap into when the startup doesn't go as well as it should. Good family supports, a history of dealing with failure. Learning from your own mistakes is, it's hard, but it builds up scar tissue and resilience, and if they know how to deal with that, we always think of that as a good thing, not a bad thing. So do not hide your past failures from investors. They will normally take great comfort from them.
Fantastic. And again, from a perspective of someone who's potentially racing for the first time, just to understand the Flying Fox process in terms of investment, what does that process look like, and what does that entail, and what can they expect if they are fortunate enough to go through the Flying Fox model?
Yeah, sure. So we've got a link on the website, a form where startups can upload their pitch decks and tell us a little bit about themselves. If it's a good match with what we're looking for, we'll set you up with an interview with it. And pretty much everything's on Zoom these days, so that can normally happen reasonably quickly. If we get to yes, we'll give you that minimum check size and then give you the final figure within a matter of days after that. So the process is being built for speed at every turn.
And how long do you expect that process to be, sort of end to end, from when a founder first fills out a form or reaches out?
It depends. If it's ready for investment, we can get to yes very quickly. We've turned things around in kind of a month. I think sometimes it takes a little bit longer for the for the actual check to land, because you've got to get the legal long forms done. But in terms of getting, like, from meeting someone to having we're ready to invest, that can be done. That's been done in short time frame. But more realistically, it's probably around 3 months. And for most of our founders, the application process is usually the start of a relationship. We tend to follow people for a little while before we invest. And maybe we've met you at an event, maybe we've met you at an accelerator, maybe you've applied through the website, and we just, stay on your update list so we can get a bit more of an idea of how you operate. It tends to, take a little bit longer.
And I guess honing in on kind of those founders that are potentially a little bit too early, as you mentioned, and as the majority of investors that have come on the show have mentioned, it's never too early for a founder to reach out and have that initial conversation. But I guess in terms of building that relationship and sort of looking at updating the investors to potentially align on when they're ready to invest and when you think that they will be ready to take on investment as well. What should that sort of cadence or communication look like, aside from getting the sort of monthly investor updates? Is there anything else that you're sort of expecting to do, or things that help in terms of building that relationship to be a little bit stronger?
Yeah, I'm actually going to just come at that question in a bit of a different way, which is, everyone says, it's never too early. But the flip side of that is that first impressions count, and you don't want your first impression to be shit, and if it's not, what is shit, like, it doesn't mean just because you don't have traction doesn't make you shit. But if you haven't done enough work, if you're clearly not ready to start having serious investment discussions, then are you really ready to be reaching out to investors? You want to be able to talk thoughtfully about your product, to be able to talk thoughtfully about your customers, and to be able to talk through what you think your fundraising strategy and needs are. And if you're not ready to do those things, I would say, just don't start that process, because you will be judged. We all write our little notes in the CRM. I would also say that with monthly updates, it's great. It's great from an investor's point of view, because I want to see what you're doing. But sometimes it's not great from the founder's point of view, because, again, I'm judging you. And if your investor updates aren't, if they're not concise, if they're waffly, I'm going to judge you. If you're setting goals and you're not hitting them, I'm going to judge you. So it's, it makes this kind of building in public and opening everything up, it's great when it works, but things don't always work. And letting people in under the hood too soon, it can limit your options. I think be mindful about what you're putting out there to potential investors, because it will be held against you.
Yeah. And that's I think really important insight for founders as well. On the investor update side, particularly if they are too early or they don't already have existing investors in place, what type of structure do you recommend for that to take? Or, again, you mentioned if it's too long or too waffly, that's a bit of a turn off for investors as well. What does the ideal investor update look like?
We see most companies using the kind of StartMate formula, which is just a very simple good, bad, ugly ask. For companies that we invest in, we put some more metrics in there. like things like what are the key metrics that this particular company is tracking. For super early companies, maybe those metrics aren't, maybe you don't want those out in the big bad world yet. So maybe just sticking to a more, to some short, snappy bullet points around the GBU format is what a lot of investors are used to seeing.
Perfect. And finally, congratulations on the launch of Flying Fox as well this week. Very exciting to have you and Rachael working together under the new model and the new brand. And as I mentioned, as part of being part of the first cohort, obviously getting to build up my own personal portfolio has been great. But I think getting to learn from both you and Rachael in terms of how you look and assess deals has just been extremely enlightening. So highly recommend anyone who's thinking about angel investing to jump on board as well. Kylie, for anyone who wants to approach you about potential investment opportunities or jumping on board as an investor into Flying Fox as well, what's the best way for them to do that?
Yeah, sure. There's forms for both on the website, which is flyingfox.vc.
Perfect. I will make sure I add those links in the show notes. Kylie, once again, thanks so much for coming on and for sharing your experience and insights on this episode.
My pleasure. Thanks so much, Ro. Take care.
Cheers. Thanks for listening to episode 151 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.